Okay, so now move to the cash management model, the Treasury model. We will have two models to be shared. First is the Baumol's model. The Baumol's model, okay, is very similar to what we learned before. Okay, remember when we learned or when we studied the inventory management, we learned the economic quantity model, economic order quantity, right? The economic order quantity is a formula you should familiar with. So remember, the CO is the ordering cost, right? Is the cost per order. D is the market demand or the demand. And CH is what? It's the inventory holding cost. Okay, now we change it. Okay, it's different shape. We change it. Here is the formula for Baumol's model. It's very similar to what we learned before on the EOQ, economic order quantity model. The logic is the same. Okay, but the parameters changed. Right now, we have the fixed cost or fixed transaction cost, such as broker's fee. We have the cash need for the next period. We have the borrowing cost. Okay, so in this formula, what we can develop, what do we can develop? We can learn the extra borrowing or extra money needs or required is subject to borrowing costs and fixed transaction costs. Okay, here what we get the number is Q. For example, here is Q. What Q means? Q means extra borrowing required or extra funding required. Okay, the extra borrowing required depends on the transaction cost and the borrowing cost. So remember this chart. Remember this chart? Okay. Here is what we learned before, and we put another parenthesis here to illustrate the same conclusion. Okay, here is the Q star is your extra borrowing required based on the transaction cost and the cost of borrowing. Okay, for the cost of borrowing, when you increase the total borrowing money, it will increase, right? The cost of borrowing. But for the fixed transaction cost, it's reduced when you increase your borrowing. Okay, because the fixed transaction cost is for example, per borrowing. And for this model, it has some limitations. It assumes a steady rundown of cash. The demand is constant. Okay, but in reality, it's not the case. And also, it assumes or it allows low buffer inventory on cash. And there may be economics in bulk selling of securities, even though this would increase the holding cost. Okay, here is the limitations of Baumol's model, but it is one of the Treasury model helping some of the companies in the world to manage their cash. And next model that we would like to illustrate a little bit longer is the Miller-Orr model. Miller-Orr model is can help the finance manager to keep cash balances within defined limits by buying short-term investments whenever cash goes over the upper limit and selling them when cash balances fall below the lower limit. So companies must first define the minimum cash balance. That means the buffer inventory. Okay, remember, for Baumol's model, there's no cash buffer, or there's no buffer inventory. It means that Miller-Orr model is a bit advanced to give the room for a company to determine the minimum cash balance. So here is the formula that you can check from your formula sheet. Baumol's model is the same as economic order quantity, so there's no another formula provided in the formula sheet. But for Miller-Orr model, it's a completely new model that you learn. So it has the association would like to put it in the formula sheet. And here we have different concepts. We have different concepts we would like to explain to you. We have the concept of return points. We have the lower limit. We have the spread, right? And also we have the transaction cost. We have the variance of cash flows. So we have a lot of different concepts that we need to explain to you. For lower limit, okay, lower limit is the minimum cash balance. Okay, so it's given by your company or by yourself. And then you base on the information in the market. For example, the transaction cost, okay, is given in the market. You can find it. What's the transaction cost on the borrowing? And then you can also have your company variance on the cash flows is your record. You have the market interest rate. So based on these three parameters, you can gather in your company and in the market, then you can find out the spread. Okay, so you determine the lower limit, and the spread can be found out by this formula. Then you can work out for the return point based on this formula. And for the spread, what does the spread mean? The spread is the difference between the upper limit and lower limit. Okay, it's the spread means. So for the return point, it's about 1/3 of the spread above the lower limit. So between the return point and the upper limit is about is the 2/3 of the spread between return point and the upper limit. Okay, because you can see the spread means upper limit minus the lower limit is the difference between these two limits. One is the upper bound, the other is lower bound. Okay, and here I will show you a graph on how the Miller-Orr model works. And here on the x-axis is time, on the y-axis is the cash balance. Okay, so for the Miller-Orr model, you determine the lower limit. Okay, and based on the market information, you can determine the return points. and also the upper limit. So all this happen. Okay, given the starting point here is at the return point, the cash balance. So when the business is going up, and also you can accumulate a lot of cash. Okay. Once it hit the upper limit, okay, from here, you buy short-term investment to reduce your cash balance to the return points instantly. So instantly, your cash balance will be reduced by 2/3 of the spread. Remember? And 2/3 of the spread, okay, will go to your short-term investments account. So unfortunately, when you buy, you just buy the short-term investment, and the cash balance keep dropping, and drop until to this point. Okay, say point Y. So in point Y, you need to sell your short-term investments immediately because it is at your cash buffer level. You cannot accept any further decline on this level. So you have to sell. You have to sell your short-term investment. To sell your short-term investment, and your cash balance, okay, to sell how much? Is 1/3 of your spread to return to the return point, okay, and then your business is going on. So here is the operations of the Miller-Orr model. I would like to show you how you make or how it works in the model. So what are the advantages or disadvantages of the Miller-Orr model? The advantages, okay, you can see my graphical illustration that they make management aware of many variables that affect cash and management. Remember, interest, transaction costs, also the variance of your cash flows. All are the factors affecting your spread, so that it helps you to understand what the variables will be affect your cash management. And trade-off that must be made between liquidity and profitability. Also, so it's easy for us in the graph here. I think it's okay to explain. It's acceptable to explain that when you would like to say you would like to increase the cash in your bank accounts until a certain limit. So if, for example, someone say, okay, why cannot go beyond the upper limits? But under this Miller-Orr model, it is not suggest to do so, because you can have better returns by placing your money or by putting your money in the short-term investments. Okay, short-term investments, however, has poor liquidity as compared to cash, right? Cash is completely liquid. For example, you just put it in the cash in your saving account, or even in your your current account, And then once you need it, you just draw it from your bank immediately, okay, without any time delay. But for short-term investment here, like you, when your cash balance dropped below the or at the lower point, lower limit, then you have to sell your short-term investment. Even you sell it immediately, given the market is open for you, okay, but it generally it takes some time to receive your money, say 2 days or 3 days or even 5 days. So it depends. Then it is not the best way if you consider liquidity only. But trade-off, okay, trade-off, there must be made between liquidity and profitability, okay. Disadvantages, it ignores the fact that cash flows are to some extent uncontrollable. Okay, how to control the cash flow? For example, the managers can delay some payments. Okay, managers can delay some payments is one example, delay payments. Okay, it's the manual intervention or the people intervention on the cash balances in your bank accounts. Next is an illustration of Miller-Orr model. So you can read it, and then we can come to how to get the numbers. All right. So here, let me explain how to, because we can just put in the formula. So it's not that difficult for these questions. People remember daily cash balance. Minimum daily cash balance is £15,000, and forecast of daily cash movement. The variance is £9 million, and the daily interest rate is 0.0236%, and also the transaction cost for each sale or purchase is £25. So based on the Miller-Orr model, then what should be the upper limit, lower limit, and the return point of the cash balances? So here, as we mentioned, the first parameter that we know is the lower limit, is the buffer cash, which is £15,000, and for the variance of cash flow is £9 million, right? And for the daily interest rate, okay, it's given 0.0236%, and also the transaction cost per sale or purchase is £25. So all these parameters given, then we first step, step one, spread. How to get the spread? Okay, based on the formula, we know that transaction cost times the variance of the cash flow, and here divided by the daily interest rate. Okay. Just based on the formula provided. Then the spread, okay, on here, if you use your calculator, you can check this. $26,826. Okay. It's the spread. It's the gap between the upper limit and lower limit. And step 2, let me find out the return point. The return point is the lower limit, which is £15,000 plus 1/3 of spread. Which is £26,000, £26,826. So the return point is £23,942. For the third step, is to get the upper limit, which is the lower limit plus the spread. Okay, so the upper limit is £41,826. So we get the spread, we get the return point, we get the upper limit. Okay, for lower limit, okay, is given. It's £15,000, which is the buffer cash that the company wants to keep. So here we describe about we just share with you under the Miller-Orr model. When there's a cash exceeding the upper limit, it goes to buy the short-term investments, and if the cash balance flow below the lower limit, it has to sell the short-term investment in order to receive the cash to cover the position, get the cash balance up to the return point. So here, we would like to share with you the short-term investment. What is short-term investment? It is a bills of exchange, acceptance credit. It can be government treasury bills. Okay, for example, in US, it's treasury bills. It can be commercial paper, the debt securities sold by companies directly to the market. It can be certificates of deposit. It can be any local authority debt securities. So the feature or the characteristic of short-term investment is very liquid, tradable, okay, can be tradable and return the money. Very liquid, tradable, well accepted is a feature. Okay, it's short-term investment. So we just share with you what are the short-term investments and how they, for example, how the Miller-Orr model work. So we move next is about the trade credits. The trade credits on the short-term finance. For trade credits, a lot of companies can use it because it is easily available and maybe free. And for another short-term finance is the bank overdraft. Short-term funds provided by the bank. Okay, for the bank overdraft, it means the funds are provided solely from the bank, allowing the current account holders to write a check even the bank balance cannot support it because the bank balance is below what you write on the check. But you have the bank overdraft facility first. Okay, it's the facility provided by the bank to you. And for overdraft, interest is only charged an outstanding balance and not on the limit of credit facility set. For example, I would like to give an example to you. For a facility letter, it say you have 5 million OD. OD means overdraft limit. Okay, so in other words, your bank account is allowed to have overdraft by maximum of 5 million. And in the days it's good business and you have very good cash flow, you have this facility, but you don't have any overdraft. You don't have any overdraft. It means you don't need to pay any interest to the bank. Okay, but you enjoy the facility here in case you are required to have the cash demand or the cash from the bank. Okay, it's maybe an advantage to you. And in some case, you have 5 million order limits. Now you need the cash, or you need to withdraw some cash from the bank to settle, for example, to settle some of your business risks. Say you draw 1 million, okay, then your interest is charged on this 1 million only, okay, on this 1 million only. The 5 million is the facility, okay, which you use it. How much you use it, then interest is only charged to the outstanding balance for the overdraft. But the bank can demand payment of overdraft at any time. Okay, if it is the liquidity issue in the market, the bank will is now turning to conscious and asking its customers to settle the overdraft maybe by today. So you have the issue, for example, under some tight issue, when the bank suddenly demand the payment of the overdraft. For acceptance of credit, it means a bank can grant the company the facility to draw bills of exchange on the bank, which the bank will accept. Okay, it is up to an agreed limit. Accepted bills are sold in the market or in the discount market by the bank on behalf of the company at a discount, and the company obtain finance from the purchaser of the discount bills. So in other words, the bank is an intermediary or an agent to help you selling the bill of exchange in the market by at a discount to and there's a buyer in the market or interest in this bills of exchange. Okay. So what's the difference between short-term funds and long-term funds? For the short-term funds, it is lower interest rate, and for long-term funds, the high interest rate or higher cost. For example, the equity. Okay, do you remember the cost of equity is always higher than the cost of debt, right? The cost of equity is always higher than cost of debt because of different risk profile. And the risk for short-term funds, it has the risk to the company because it has the rollover risk. What does it mean? Rollover risk means, as I shared with you before, if a company would like to use the overdraft to finance its operations, that the bank has the terms that the bank can demand the payment immediately or at any time. So you don't know when is the overdraft cannot be extended. If, for example, if it cannot be extended by tomorrow, then you have a rollover risk of the loan, because the loan or the overdraft is a loan to you. If it is due tomorrow, how can you find another person to lend you money to cover its funding gap or the funding shortage? Okay, this is so that it is rollover risk. You cannot roll over the overdraft day after day without any risk. Okay, you have the rollover risk. But for the long-term loan or long-term fundings, such risk is very low because the terms stated clear. When I provide you fundings, for example, say 5 years or 10 years, I cannot get back my money until until the debt is mature enough. I can get the funding repaid by you, but you have to pay me interest much higher than the short-term funds. And flexibility. For short-term fund, the interest vary more often, and for interest in long-term fund, for the interest is fixed for long term. It doesn't change in a short period of time. So for the short-term fund, the flexibility means that if the interest rate trend is going downward, it helps the profitability to be improved if you are using the short-term funds. But for long-term funds, if you are projecting the interest rate is to be going up, then you lock up the money now, and given the interest rate is fixed for a while or period, then it helps in future for you to save the money back. So last but not the least is about the matching. Okay, for short-term fund, it is good, especially when you are financing some current assets. Okay, but remember, we have the terms, and in last class, we have the permanent current assets. Okay, remember these terms. Okay, for permanent current assets, it's much better to be financed by the long-term fund, or part of it to be financed by the long-term fund, given it can provide you better liquidity. Okay, even your profits will be a bit affected. Okay, and for long-term funds, it's suitable for financing of fixed asset or permanent current assets. Okay, it's say here.